All right. So welcome everyone to this third edition of our UnConference about cryptoeconomics, where we discuss several topics, theories, ideas, and events related to cryptoeconomics. But it doesn't follow any specific order or path, let's say. We want these sessions to be like spontaneous, and we just bring topics up according to when they are occurring on real time. So today, as I was mentioning, we will talk a little bit about stable coins. And what I'd like to do is to use this concept of stable coins to illustrate a couple of things related to cryptoeconomics, whereby, as usual in cryptoeconomics, it's about correctly designing a set of incentives through different mechanisms in order to modify or change the behavior, or incentivize the behavior of people to act in a certain way that is supposedly beneficial to the project or the type of actions or outcomes that we want to happen. So in this case, we'd like to have a coin which is stable by design, but without any central authority to make sure or to make that coin stable at all time. It should come out of a set of incentives that will together ensure the stability of the coin. And so there are a lot of ways to do so. Well, not a lot, but actually three categories of stable coins at the moment have been explained very broadly in this article I sent you beforehand, and is written by Asib Qureshi on Hacker Noon. I hope you can all see the article here. And what I will do is go over it briefly, so we have a general understanding of the three possible designs that coexist at the moment for stable coins. And then with Sandra, one of the projects that we analyzed a little bit more deeply was MakerDAO, who is working on one of those three designs. And well, actually, I think it's a little bit more elaborated than that, but we'll come to it later. And then what I would like to do is to have an open discussion with the pros and cons of all the designs, and maybe specifically about Maker. And yeah, so that's the plan. I'm going to be quick in the introduction so that we can have the best part later with the most amount of time. Okay. So in this article, they present stable coins really as the holy grail of crypto. And it is thought to be a holy grail because of two reasons, basically. One of them is the volatility issue of cryptocurrencies in general. And the other is the speculative aspects of every cryptocurrencies, or even crypto project at large, you might say. So the volatility issue is related to the price variation, whether that's daily, weekly, weekly or monthly, whatever. There is a huge volatility. Ether, Bitcoin, and the top five, let's say, cryptocurrencies can sometimes have a variation in price of more than 20 or 30% per day, which is really tricky when you try to make a business or have a constant, stable activity where you have to pay rents, you have to pay salaries, you have to invoice people and so on. If you have to adjust for the price of what you are invoicing every day, you can't even do that in the future because you can't predict really what the price is going to be. So it's really difficult. The second aspect of hello to the Ricardo. Can you mute your microphone, please? Thank you. So the second aspect of this holy grail is the speculation, and it is related to the fact that in every project or crypto project, it is very difficult to avoid the speculative aspect of your token, even if you don't want it to be a speculative asset. And that's a reality, because you can't avoid secondary market, even if you didn't share or distribute your tokens on exchanges. There's always going to be speculation, and this might interfere with your original plans for running your community, because suddenly this attractiveness to the increase of the price of your token is going to be more important than maybe what you're actually wanting to do with your token. So the holy grail of crypto seems to be stable coins. Again, I'm not going to give my opinion now. It's just a summary of the article. And so, how do we design stable coins, right? So I'll skip or go over this bit quite fast. It is basically a reminder of the fact that stablecoin, it's pretty common, right? And we can just use a term which is peg, and that means that you issue a token that is equivalent to $1, and this has been the case for many times now, many times, yes. And that leads to several crises as well, always because of the fact that you have to trust that the correct amount of value behind the token is always available to face decrease or increase in the price of the currency. Okay, so the problem that we are facing is that we have to be able to withstand enough volatility in this peg. It is expensive or not to maintain the peg at all time. You have to have a reserve at hand in order to face those volatility deviation.
The question in, yeah.
Yes, go ahead.
Hello. Is it always, or is it in a time frame that you maintain the peg?
Yes, that's the thing, right? You have to be able to handle to resist to the volatility in a time frame that is correct. And by correct, there are several ways to estimate it. Maybe, or at least in crypto in general, it's a way of, it's synonym to how long people are going to trust that the stable coin, for instance, is actually going to recover, whether that's from a higher price according to what's the normal peg, or it's below it. So the window of stability is also an important aspect.
Yeah. So what's the usual time frame, as in the window? Is it a day, or is it seconds?
Well, right now in crypto-related stable coins, it's very hard to say because there are not many projects, and the projects that exist have not been have not been used for a long amount of time. So it is not really a variable that we can clearly quantify at the moment, so that I know.
Okay.
So it has to be easy to analyze the band of behavior from which it can recover. So what kind of instruments or behaviors are going to use the people to recover from a deviation from the correct price? And finally, the transparency of the traders should be something also included, so that more trust can be built within the community. So a first aspect of cryptoeconomics that we can see here is the concept of Schelling points. So in this case, the Schelling point is about making it so that the normal behavior of people is going to be in line with enhancing or maintaining the stability of the coin itself. If it's the easiest and the better behavior for each one of the participants. It's called a scaling point, and it's going to produce the outcome that you want the stablecoin to have, which is stability. And we'll come to that a bit later. Okay, so this is the summary of the three categories for stablecoins that we have at the moment, and there are more. I mean, there are more than 3 projects, but those 3 categories seems to summarize everything. So the first one is a fiat collateralized stablecoin. The second one would be a crypto collateralized stablecoin, and the third one would be a non-collateralized stablecoin. So by collateralized, we mean that before issuing those stable coins, you need to have something of value at hand, right? And that thing of value, in this case, is a fiat currency. So whether that's dollar, euro, yen, won, whatever. In a crypto collateralized stablecoin, it's a crypto asset. So Bitcoin, Ether, DGX Gold, whatever. And in the third category, there is no collateralization. And we'll see how they manage to ensure stability without a collateral. So the first one, which is a fiat collateralized stablecoins, it's the easiest one. So you basically issue token from a reserve of value that you have, whether, say, in a bank account. So you have a huge amount of, or you have dollars in a bank account, and if you have 10,000, then you can issue 10,000 tokens and say they are stable, because you can always redeem your dollars for each token that has been issued. So it's a one-to-one peg, if you will. So this is extremely easy. It's really stable because it's pegged to the value of the underlying asset, which is dollar or euro. But it has some problems. It is extremely centralized because you need to trust the custodian for the fiat currency to have that currency on their bank account and to properly manage that reserve. And it is expensive and slow liquidation into fiat. So expensive because you need to gather that reserve of dollars or euro, and the liquidation into fiat can be quite slow. It is also highly regulated because of the reserve that you are managing. And you need regular audits to ensure transparency, because there is no connection between the blockchain and the traditional banking system. So I assume you have heard of Tether, which is the main project in this category that recently went under scrutiny and a bit of worries from the community because of the transparency about their reserves, right? So the community in general had fears that Tether didn't have enough dollar according to the proportional to the tokens that they were issuing. So they were acting like a fractional reserve, meaning that they didn't have all the dollars that they were issuing through their tokens, but only a fraction of it, which is not what you want, obviously. Can you please mute your mics if you're not speaking? Thank you. Okay, so the second category are the crypto collateralized stablecoins. And what you do basically in this type of project is that you gather a crypto asset, so Bitcoin, Ether, DGX Gold, whatever. And with that, you can issue your token. So exactly the same mechanisms as before, but in this case, a crypto asset. So you gain here from the previous category because you don't need to translate your reserve into the blockchain by some mechanisms, everything is already on the blockchain. The issue with a crypto collateralized stablecoin is that you have to take into consideration the volatility of the collateral itself. So if you issue, I don't know, 100 token from 100 Ether token, if the price of Ether is crashing, the price of your stablecoin will obviously not be stable anymore and would crash the same way. So you have to find new mechanisms to counteract that volatility of the underlying crypto asset by another way, right? And this is where it gets really, really interesting. So the general idea they are mentioning here is that you over-collateralize. So you say, if you bring 100 Ether, you will only be able to withdraw 25 stable coins. So that if there is a huge fluctuation in the price of ETH, then that volatility can be absorbed because you over-collateralized your stable coin, right? So there is enough, yet there's still enough value in the collateral to represent or to back the stable coin itself. We'll see though that this is not enough, because huge crashes can go even under that, right? Or under that over collateralization, and make it things worse. But that's the general idea. Okay. In this category is where you find Maker, for instance. So it's a little bit. Oh, it's a lot more decentralized, obviously. The liquidation part is very quick and cheap.
I have a question.
Yes, go ahead.
Is there any way how they calculate how much you will overpay, or is it just a random number?
You mean how much you have to over collateralize?
Yeah. Mm-hmm.
So I can speak about Maker, and I'm gonna talk about that a bit later. But yes, so this is a variable that the community can set for each crypto asset. So in the case of Maker, what they do is that the governance of Maker allow the community to set different security parameters. And one of them is the over collateralization for each crypto asset that is allowed to be used in the Maker ecosystem. And for instance, for Ether, right now it's 150%.
And why is it 150%?
Well, it could be something different. If you want to assume more risks, then you should lower that variable. Right now, they have estimated that was the correct percentage.
And how did they estimate this?
Well, I haven't done the calculation myself, but I can imagine that what they do is to calculate the volatility of Ether for a certain period of time, and they say that generally, if you have more than 150% of collateral, you won't be in trouble, basically.
Mm-hmm. Okay.
But this is a moving value that could change, yes.
Mm-hmm. Okay, thank you.
So it is very transparent, again, because we are here 100% in the blockchain space, and there's no connection to anything else. And it can be used to create leverage. So this is something, it's a use case, if you will, that you can use when everything is on the blockchain. And it means basically that if you buy from if you buy with 100 Ether 25 stable coin, then with those 25 stable coins, you could buy 25 more Ether if that was the price, right? So you would have now 125 Ether, right? So 25 more than what you had before. This is called a leveraged position. And this is interesting if you're bullish, for instance, on Ether, then you can create a leverage that way. The downside of it is that you can be auto-liquidated, and we'll see how that happen. So if there is a crash in the price of the collateral, then the project, the mechanisms will react automatically, and you will be liquidated. Same way with margin trading. If your margin called during a crash, it's what happens here. It's obviously less stable. Yes, KP, yeah, go ahead.
Yeah, how does this work? How does this over-collateralization work in a bearish market? It sounds nice in a bearish market.
Yeah.
It sounds nice in a bullish market, but in a bearish market, how does this actually work?
Okay, yeah, it's a good question. So there are several measures that I will discuss a bit later in the maker part. But there are several measures that can prevent the system to crash entirely. The first one, as I've mentioned, is the over-collateralization. So if you have over 150% more collateral than what is in circulation, then you can still handle a bearish market for some time, right? Not indefinitely, but for some times that works. So this is the first one. The second one, in the case of Maker, for instance, is an additional or a secondary reserve of value in the name which is encapsulated in another token, which is the MKR token, that they can use, that the system can use automatically to use that reserve and counteract a very bearish market that would last, say, longer than it should. So if a lot of stable coins, for instance, would have to be removed from circulation very quickly because of a price crash of the collateral, what can happen is that other token is going to be diluted by minting new ones, and that extra value just created out of thin air can then buy back the stable coin from the market and remove it from circulation to go back to the situation where there is always enough collateral to back the value of the stable coin in circulation. Then the third measure that is used in the case of Maker is a global settlement. So if the system cannot handle things properly anymore, then there is, if you like, a red button that the community can press, and everything will be force liquidated for you. So you will get whatever value was left from the collateral and from what can be extracted from the selling of the stablecoin itself in the open market, and you will get everything back as you will get the value of the collateral back as much as the system can give you, of course. Those are the three measures that I can see from Maker. Okay, so less stable than fiat, of course. Well, this is a matter of volume trading each day, obviously, but in general, it's less stable. It's more difficult to ensure stability. It can be tied to the health of a particular cryptocurrency, so it really depends on the basket of cryptocurrencies that is used. It is an inefficient use of capital. Well, depends on the perspective, but in the context here of Maker, it means that you lock capital without really using it. And it's obviously most complex. Okay, so the third category of stablecoins now is the one where you don't use any collateral. So why is that? Most currencies, most fiat currencies doesn't use collateral. The dollar, for instance, was unpegged from gold almost 60 years ago now. I mean, definitely, right? Nevertheless, Nevertheless, there is a sort of stability in the dollar. It always depends on the window of time that you are evaluating that stability, of course. But generally speaking, the dollar is a stable currency without any collateral. So this is actually something that was argumented by Hayek, which is a famous economist, especially in the crypto space, that I highly recommend you to study. And so what you do in this case is basically playing with a monetary policy. So if you issue a token which has to be stable by design but without any collateral, what you do is that if that stable coin is, the price of the stable coin is going above or under what should be considered the stability, like for instance $1, then what you simply do is to modify the supply of money by minting new tokens or by removing those tokens from circulation, so that you you modify the supply of money, and at the same time, because of supply and demand economics, then the price should go up or down accordingly, right? This is what is called a seigniorage shares type of scheme that was invented by Robert Sams in 2014. And it can get a bit more complicated, but we won't get into the details because time is running. You can look it for yourself here. Just to give you an idea, what they say is that instead of having to repay, for instance, if the stable coin is not stable because what is happening is that the price is above what it should be, then what you have to do is remove some stable coins from circulation. And so to do that, you will want to buy them, or you will want to extract them from circulation. But instead of using actual dollars, for instance, or money, what you say is that you write them a check, if you like. So it's a share, a seigniorage share, where they will be able to reclaim that value in the future when the other scenario is occurring, right? So it has also some problems.
Hi, Lauren. Just a question.
Yes.
Yeah. So is it something? I think this is a real world case of mixture of open market operations in financial world and then what do you say, bond market, something kind of sort of.
What do you mean for the seigniorage shares type of scheme?
Yeah. Seigniorage shares type of schemes of open market operations. When the liquidity goes down, you release the shares and then take a buyback. And in kind of, when liquidity is high, you buy back the things.
Yeah, it's a financial instrument. I'm not an expert on those things. And
then in bond market, what you do is, once you release the liquidity, you set up a bond for around 5 years or 10 years, and then you pay interest on it. Sort of sense. It's a combination of both.
Okay, well, thank you for the clarification. So this might work as well. There is no collateral required, and it's decentralized and independent. There is no trust issue to third parties. The thing is, it requires continual growth, and that's because in bearish market, if I'm not mistaken, so in bearish market, what you will do is issue those seigniorage shares that the people buying them will be able to reclaim if the market flips to a bullish market in the future. So, but there's always that idea that if growth is perpetual, then what you spend today, say, to remove stablecoin from circulation, you will actually make money on the future. But if that's not the case, if your small economy here is not growing anymore, you won't. So this is a risk intrinsic to this type of design. Okay, so they conclude the article by saying that there is no optimal design. By optimal here, they mention 3 elements, which is secure to crashes, decentralized, and collateral efficient, right? So it's a matter of seeing different schemes and different designs popping up and distributed or released into the wild, and see how the community react, and when the system is used, what's happening, right? Okay, so does somebody want to add something to this quick summary of the article? If not, then I'll move to highlight some aspects of Maker.
Hi.
Yes, go ahead.
So it only so the article only stabilizes on 3 main points. One is that either you can go on first fiat collateralized, crypto collateralized, or non-collateralized. There are multiple hybrid systems also you can build it on. Few parts of fiat collateralized, few parts of crypto collateralized, or hybrid of crypto and non-collateralized system. I've seen one of the coin, I don't remember the name. It's from the Japan, which is working on this part of system of hybrid of this.
Yes, I totally agree with you. And in fact, Maker is also a hybrid in a sense of those things, because Maker is actually using crypto collateralized type of design, but they also play with the monetary policy as in a non-collateralized scheme, but that's done through cryptoeconomics. So yeah, good point.
I had a question as well, if you allow me.
Yes, go ahead.
I was wondering, I think at some point it might be a little bit philosophical, but at some point we haven't seen the applications that we could buy with the cryptocurrencies. And as of today, the only thing we can buy are actually services and products from the real world. So that's probably the reason why we want to have a stable coin. But maybe 2-3 years down the road, we will have maybe pure players or pure products that are created, especially in the crypto sphere and crypto world, that could be purchased directly with cryptocurrencies. And in that case, the volatility issue that we have, which is a bridge basically between the crypto world and the real world, will just disappear. And the reason I'm saying this is because one of the projects in the US, I think it's a project from Grid Plus, from Consensus. One of the tokens is actually collateralized as well with a kilowatt hour. It's different from a cryptocurrencies, it's different from a dollar, but it's also an example. And the price of the kilowatt hour over time is different. However, in their case, they make it stable. And well, that's just a couple of thoughts here, but I think we are just seeing a transition, and maybe this notion of stablecoin will disappear in coming years.
Thank you. Excellent point.
And I will also add to the Alexander that once the markets matures, supply-demand situation already exists. It doesn't have to be forced onto it. Just like if Bitcoin and any Ethereum, any of the major currencies can take it down, then within 2 to 3 years, the stable coin things will be already stable.
Mm-hmm.
Yes, absolutely. It's what I wanted to say first. Andreas Antonopoulos actually discussed the stability of crypto assets in one of his videos. Can you mute your mic, Alexandre, please?
No, sorry.
Thank you. And he's introducing the concept by saying it's like going in the open ocean with a boat, right? And a fiat currency type of boat would be a huge, one of those big boats that transport containers to ship from Asia to Europe or to America, whatever. That kind of boat. So when there is a storm with a lot of waves and wind and so on, the boat will start tangling a little bit, but almost nothing. It's going to resist a storm perfectly. And that's because it has a lot of volume traded each day. But cryptocurrency or a crypto asset like Ether or Bitcoin, whatever, it's a very small boat. So at the first wave, it's going to feel the wave a lot and maybe even flip, in the ocean. And that's because the volume being traded is a lot less, right? So as Rupesh was saying, at some point, we're going to see more, or we hope, more volume being traded each day. And so the volatility issue is going to be less in the future. The other thing I wanted to mention to your question, specifically regarding the project itself, I think what they do is actually a fiat collateralized scheme because they need liquidity in their system to make the transaction of energy between their clients and themselves to be able to act as an electricity distributor in the US. But it is true that for many projects, the use of a stable coin is really would really be important to avoid that speculation. I think I was mentioning at the beginning. Yeah.
Since we are talking about the US, how does Maker or any stable coin come under SEC? It's at the end of the day, it's mostly users manipulating the price between themselves, or big traders manipulating price between themselves. So how does this come under? How does it play under SEC? And
yeah, so
if you remember the big people, yeah.
I don't have that knowledge for all the projects. I know, and I'm 90% sure that for the case of Maker, it has not been classified under a security. But for other projects, I'm not sure. I don't think actually that they are considered securities, because there is no promise of increased in value. They are actually trying to be as close as possible to one value without. If they could not move from that specific price, they wouldn't. So, yeah. But if anybody has more knowledge than I have about that, please go ahead. If not, then we can investigate a little bit more and maybe keep discussing it in Telegram or Discord.
Mm-hmm.
Is that okay?
Okay. Yep.
Okay, thank you. So very briefly, because we are running out of time, what Maker is doing, right, is to use the collateral and open what they call a collateralized debt position to create their stable coin, which is called DAI. A collateralized debt position is a smart contract that will hold the collateral, which can be cryptocurrencies, assets, it can be whatever that is readable directly on the blockchain. And the smart contract will hold the collateral for you and allow you to withdraw from it a certain amount of DAI. If you give the smart contract back the DAI by the correct amount, you can take the collateral back and do whatever you want with it. So it's a two-way type of smart contract. But once the collateral is sent to the contract and you removed, you withdraw the DAI, then you can't touch the collateral anymore. So the idea for any good collateralized debt position is to have this kind of situation where you have a lot more collateral in value than DAI, right? And this ratio is approximately 150%. But things will not always happen or occur the way that was intended, right? So in the first part of this graph, what you see is things are relatively stable, if you will. So the stable coin is really, really close to the reference, in this case, the dollar. But here at the extreme left, right, you see two scenarios. One which is risky and one which is unstable. In the risky one, what happens is that you have the value of the collateral is approaching the value of the DAI. So that would mean, say, the price of Ether is going down and very closely to the actual value of DAI that hasn't moved, right? Because it's still $180 here. But this is going, this is reaching the limit. And so in the other case, in the case of an unstable situation, it is where the value of the collateral is going even below. But in the first one, so the case where the price of the collateral is really close to the value of DAI, but not under, the CDP is so the collateralized debt position, the smart contract, must be liquidated because it is said to be too dangerous to leave it open. So in the case, the system will liquidate that position, and in doing so, it will sell the collateral, so Ether that was held by the CEP. It will sell that collateral, so the Ether, for DAI. And in doing so, it will close the position, and at the same time, it will pay a fee and a penalty to not have done that like properly by the holder of the CDP before. So the idea here, right, is because the stable coin was increasing in price, what you need to do is to remove DAI from circulation. And so you are using the collateral to buy DAI from circulation and destroy it. That's the idea. In doing so, what you're also doing is modifying the ratio, right? The ratio between the pool ETH, which is the Ether that is used to issue new DAI, and because you have modifying the supply of ETH, then what happens in the end is that one ETH can claim more than one ETH. So this is because, if you remember, what you have done is you have sold the collateral for a DAI. Okay. In the case of a underwater collateralized debt position, so the value of the collateral is going below the actual value of DAI, things are much worse, right? Because the stablecoin is not backed by enough value anymore, so there is two squares here missing. And in this case, it must be covered, right? It means that there is a lack of value in the system. And to provide that extra value that is needed to go back to a situation where there is enough value in the collateral, the remaining collateral in the debt position will be sold for DAI, and with that DAI, it will mint new Ether. This new Ether is, as you can see, a P Ether, right? Which is a token that they are providing to the system. But in doing so, they're also modifying the supply of PETH, of pooled ETH. And so in doing so, they are increasing the supply. So in the end, one PETH can claim less than one ETH. So for the system, in this situation, this is really, or it is not positive, to say the least, right? Because you are reducing the, you are diluting, basically, the pooled ETH in general. Okay, so this is the way they are using.
Just a quick question, Laurent. Yeah. How do they define the levels of, when crashes happen? How do they define the levels, and at what certain levels the system needs to exchange, with collateral CDP, and how the community perceives it then?
Yes. So in the case of this first iteration with the pooled ETH, which is the first version of the DAI system, the only crypto asset that is allowed to be used is pooled ETH, as I said, and the rule for a CDP to be considered a good CDP is that it has to be over collateralized by 150%. So if it's approaching that value, then it's going to be liquidated automatically for you. And if it's going on the water, so in the case of a crash of Ether, then it's going to automatically mint new pooled ETH to provide that extra value that is missing from the system.
Okay, so my question was certain this. Is there a time period being defined, or is there a market watch? Is there's some kind of a ticker market watcher that's keep on track on all this part?
So I think your question is related to how they feed information into the system. Is that correct?
Yeah.
So they have a whole infrastructure of oracles at the moment, but are not very fancy, because the only thing they do is to feed the system with prices. But from I think it's 12 now different ones that are used for the different prices that they need, right? And in addition to that, they also have several measures, because obviously oracles can be hacked, and this is really a critical part of the system, because everything depends on the price that the system is being fed, right? So to prevent that, they have some measures or extra measures, like a delay in between the average price that is calculated and when the system is able to react, and a couple of others that I don't remember at the moment. But so this is the basic thing that happens in the Maker ecosystem to equilibrate the supply of DAI according to the value in the underlying collateral, right? And the next question is, why would anybody play this game? So why would I help or participate in this stabilization of the DAI itself? And what we have in this game, right, is 2, maybe 3 kinds of players. The first one are users who just want to pay bills and charge other people for services or whatever, so they just need a stable coin. So what they do is they hold DAI, and they want to use it as a medium of exchange, and they value the stability, and they need DAI to be accepted pretty much everywhere. Then, and this is one class, right? Then we have the financiers, who are people that will borrow DAI. So they will be the one responsible of creating liquidity in the DAI market. So issuing them or buying them or removing them from circulation. And they will do that only if there is a profit to be made, right? So there are people that are risk seekers. They don't mind the risks. They use DAI or they see DAI as an investment. They want to make a profit, and they value the reliability and responsibility of the DAI system in order to be able to do so quickly and nicely, right? Okay, so how is that a profitable game to actually make the token stable? Well, we will see here two situations. One which is where the DAI is below the dollar itself, and another one which is the opposite, where the DAI price is above the price of the dollar. By the way, at the moment, what they have chosen as a stability reference is the price of the dollar. Take into account that in general, if you give the system 100 Ether, you can take 25 DAI, that would be 150%. But if you want to take your 100 Ether back, you'll have to pay a little bit more than what you could withdraw. And this is how basically you pay for the system. There is fees involved here. So with that in mind, in the first situation, what is happening for somebody looking to make a profit is that at this moment, DAI is cheaper than it should be, right? Because I know normally DAI should cost $1, but here it's below, so it's cheaper. So as a person looking to make a profit, what I would do now is buy in, right? I would exchange my dollar or Ether for DAI. If I had a CDP open, so if I had already issued DAI in the past, now I would close it, right? Because I can close the CDP and pay the commission that I was mentioning before at a lower price than what I would normally have to, right? Because again, the price of the DAI is below what it should be. So it's interesting for me to close it now and not later. And those two actions have as consequences that the demand for DAI will increase. Some people here will buy DAI, and the supply of DAI will decrease because of the financiers closing their position. And supply and demand, again, this should have the consequences of increasing the price of DAI, and so put it back very close to the dollar. And in the other situation, what happens is exactly the opposite. So here the DAI is more expensive than it should be. So if I'm a user who wants to use DAI, I won't probably buy now because it's more expensive than it should be, right? So I'll wait. If I'm a financier and I'm looking to make a profit, now is the time to open more CDP, because the price of DAI is above what it should be, and therefore it will cost me less to handle that. And again, supply and demand, this will decrease the demand for DAI and increase the supply, and therefore the price of DAI should decrease and slowly going back to the price of the dollar, right? So this is how cryptoeconomics here is being used. Well, one slice of it to ensure stability, not by playing directly as a central authority with the monetary policy, supply and demand of the cryptocurrency, but by automatically, I mean, by that the smart contract, by inversing the incentives in one way or the other, to change the behavior of people looking to make a profit so that they themselves, in doing a profit, participate in stabilizing the token itself and allow the normal users to almost always be able to buy the DAI at a price close to the stability reference, in this case, the dollar. I won't get into more details right now because I don't have the time, but there is more into it, and I will be happy to go into more details in another session. I'm really sorry that it took more time than I expected, but I leave the floor to you now if you have any questions or you want to discuss some aspects.
Yeah, so hi, Lauren. See, I wanted to ask something. Can you hear me?
Yeah, go ahead.
Yeah, see, so what is this, how do you value this pooled ether? Is it a coin? How is it valued and how much coins are there?
Yes, so the pooled ether is a momentarily solution that they created right now to be able to control, well, the system, not themselves, but the system to control a reserve of value, right? And again, this is more complex because we haven't touched the MKR part, which is their own token. But they use the pooled ETH as a combination of both the way to issue DAI and the reserve of last resort, which is the MKR in the future. Okay, so let me explain what that means. They created pooled ETH that can be minted, so there is no limit or no cap on that token. It is a new token that they have created, and it is a token that is used when someone wants to issue DAI. But at the same time, because it has it has value, and the system can play with the monetary policy by minting new pooled ETH or by removing them from circulation and burning them. They can incentivize incentivize people to do the right thing. So what I was mentioning before, if you reach a situation where, let me put the slide back on again. Yeah, so if you are in the situation when there is, this one, which is a risky CDP. So you are a financier and you forget about your CDP and the price of Ether was crashing or were going down. And it reaches that situation very dangerous for the system. So in this case, your CDP will be liquidated, and as a consequence, you will go away from that original ratio, which was that 1 P ETH was equal to 1 ETH. But because half the fees are paid in P ETH and then burned, the supply of P ETH decreases. So 1 P ETH can claim more than 1 ETH. Okay, so in closing a position, right, you have to pay a fee. And when you do that, that fee is not paid directly to the person, but it is paid by playing with inflation, right? By burning P ETH. And so the ratio at the end of this operation will change to the benefits of the people holding P ETH, obviously. This in the situation which is risky, but still okay. In the other one, it's the opposite. Here, because you are underwater, the system reacts for you. But in this case, because there is a lack of real value to back the DAI in circulation, what you need is extra value. And this, again, automatically is done by the system or handled by the system by by minting new ETH, new PETH. But by increasing the supply of PETH, you're diluting the people that was holding PETH before. So in this case, your PETH can claim less than 1 ETH, which was the original situation. So if the system goes wrong, you are losing value if you had skin in the game. In the future, it is not going to be PETH, but the MKR itself that will play this role of being a reserve of last resort, right? So when the system go underwater, the people taking the decision in the Maker ecosystem will have will be responsible financially of their decisions by letting the system use their financial property, their MKR tokens, to do what I've just explained now with PETH. Does that make sense?
Yes. So basically, 1 PETH is pegged to 1 Ether.
Originally, yes.
Right.
But as soon as the system or the participants play with it, the ratio will change.
So with this Maker and DAI is one and the same, because when Maker comes into existence, what happens with DAI? It's the same coin.
Yeah. So Maker DAO is the company,
yeah,
and the DAI is the name of the stablecoin.
Right. Right. Okay.
Thank you for your question. Yeah, go ahead, KP.
Thanks, Lauren.
Do you have enough time to talk about liquidation? For example, what happened in March and January?
The correction.
How did pool it work in those situations? How did liquidation happen?
Okay. Actually, let me ask the audience in general. I can keep discussing a little bit more longer this time, but if you have to go, feel free to leave the room. There's no problem. So yeah. So are you referring to the event that happened at the end of March?
Yeah, in January and March. So I think in January their bot didn't work, and in March I'm not sure how the crash happened.
So because I was willing to mention this article, which I don't know if this is what you were referring to or not.
I'm not sure.
Okay, so let me ask you again. What's your question? I'm not sure I understand.
So you said that pool up or auto liquidation happens by the system, right?
Yes.
So in March there was a flash crash, and in January there was a flash crash.
In Ether?
No, in DAI.
Oh yeah. Okay. Yes.
So what happens in these situations? Does auto liquidation just liquidate, and in case of liquidation, how does the system recover? Because in the flash crash, it actually came back to the stable $1 price. So how did this actually work?
Yes. So take into consideration that at the moment the DAI ecosystem is quite small, and all this is very new. So things can go, say, wrong because of one or two individuals, or something in the set of smart contracts or whatever. So as far as I know, those two situations were due to one or two individuals that hadn't seen that their CDP was reaching the liquidation ratio. Yeah.
The situation happened because the bot and buy box didn't work. So that's how the crash happened. But what I wanted to know is, when a crash happens, how does the auto liquidation work? What does a maker get? And how does it go back to normal?
Yeah. So if this is only due to one CDP that wasn't handled properly, the whole system shouldn't be affected, right? Although at some point, if this is bad enough for the whole ecosystem, then the pooled ETH, for instance, will be diluted, and therefore everybody would suffer some consequences of that bad behavior, or that that thing that didn't go according to plan. But the system itself recovered, meaning that the system reacted the way it had to. And there is no bad or wrong here for anybody. It's just that the system itself could survive that flash crash or that problem by providing enough liquidity, or by doing what had to be done to go back on the reference stability, basically. And the same thing happened here in the article I was mentioning on the screen at the end of March. The article is really good because it goes through. It's like an investigation type of article describing how to understand that peak at the end of March, and it was due to again a CDP not being handled properly. That was a big one. And again, the system reacted as planned, as it should be, to correct what was happening. I don't know. Do you have another explanation or views on it? I'm sorry?
Yeah, I guess we'll take it offline. An offline discussion.
Oh, an offline discussion. Sure.
Yeah.
One quick question. You are saying that the CDP was not handled properly. Does it mean that every single user has to program the CDP? It's not supposed to be a smart contract, being the same for everyone?
Right, no. So the way it works is that you, as a financier, so if you want to issue DAI, you will have personally to lock a pooled ETH into their system by opening. Essentially, you will be creating a new smart contract, a new CDP, which is something already done for you, right? You don't have to write it down or anything, but you will create your own CDP to be able to issue the DAI. So in this sense, you are responsible of your CDPs that you have opened. You don't share that responsibility with the community.
Okay.
Laura, one quick question from my side. As in, what is the use cases of DAI? I want to understand, apart from the being a bridge between lenders and being something people who want to get in. What are the actual use cases? If DAI isn't used in natural and general cases which people are using and buying and things and not anything, then why the stablecoin actually exists? And as an investor, if I am an financial, I would love to I would be willing to put more money into the riskier investment than the stable thing.
Right. So I can think of several use cases, and but please feel free to add more to it or comment on it. So as I said before, the first one is the possibility to create a leveraged position on your crypto asset by doing margin trading, essentially, but here for free. So you can lock the Ether that you have if you are bullish on Ether, and get a leveraged position. Other use cases that might be a bit more interesting for normal people is the possibility to make a loan for yourself with your with the ether, for instance, that you might already have. So if you lock 100 ether right now, you will get a certain amount of DAI, 25 or something. And this is money that you can spend on whatever you want, but you still have ownership of the 100 ether that you locked in the first place. So in a sense, it is a way to make a loan to yourself and repay it whenever you want to, right? You obviously have to now handle the both. You'll have to control both ends of the equation. So pay attention to what's happening to your collateral, the price of the collateral, and also having enough liquidity, so enough DAI, in the case of a problem in the collateral itself. But if you provide enough, if you collateralize enough your position, then you can spend that DAI on whatever you want. You don't need to go to a bank and ask for a loan there. You can do it yourself. Other use cases that I can see really interesting is for ICOs. So instead of raising huge amount of money today, but also tomorrow because of the increase of the price of your token, or on the contrary, the price of your token going down, if you had the possibility to raise money with something that has some stability, like the close to $1, then you could make it quite significantly more professional. I think the aspect of raising capital to build projects, right? Another use cases that is mentioned is a payment. So remittances, I think they call them. So payment between countries for trading purposes, and so on and so forth. Also not mentioned, I didn't mention it in the case of making a loan to yourself, but think of the possibility of putting other crypto assets in addition to Ether. So you might have a possibility in the future, and I know for a fact that this is what a project like SweetBridge, in cooperation with Ethereum, is doing, is a possibility to use as a collateral your house, your car, your stocks, your properties that you have, titles, whatever, because what they're working on their side is on translating or offering the possibility for people to represent physical assets onto the blockchain directly, right? So if you could use that as collateral, then it's not just some ethers that you bought 1 year ago that you can use, but you could actually use the assets that you already have today yourself to start, I don't know, building a business, to expand your business, to handle a complicated situation that you might have personally or whatever. So there are more and more use cases that will come. But basically, I see it as like the everyday currency of the blockchain space, basically. And I think that's already a huge use case. Don't you think?
Yeah. So mainly, they are mainly into the financials instrument market at present right now. But once the I would say that the number of DAIs the issue increases, then they can more capture into the consumer side market also. That's the reason.
Yes, essentially, it's a financial product for the crypto space.
The more people have DAI, then the more they can use it, and then automatically the things get built up in the growth stage. So they have, particularly at present time, financial, they are targeting up, and then they're looking to grow into the other segments also, like consumer side or somewhere. Anyhow, we have to use DAIs for all these things, and if the use cases of DAIs doesn't increase, the value of only the financial things, right? And I don't know, I can exchange for ether to any other currencies or all this thing, but the value use cases of DAIs only will increase once we can do something on consumer side also.
Yes, I agree, and I think this is something that we still need to. I personally want to see more of it, right? In the case of Maker, I think the architecture is really fascinating and really good. I mean, so far it has worked, as I've said before, and the graph is showing it. So it can maintain stability in a decentralized fashion, and it is a business. So people are participating in that because they can make a profit. And in doing so, they ensure the stability. So this is really fascinating. But of course, you need people to use DAI for, right? If there is no demand for DAI, there is no point in stabilizing DAI in the first place. And the consumer side is what I think is a bit is lacking at the moment. But I understand also that this is something that that can come a bit later. You first need to prove that you can handle complicated situations like the one we've been living in the past 4 months or so, and that the system reacted properly. The project I was mentioning before, SweetBridge, that is working on the supply chain in general, is also doing actually a stablecoin. So they have their own design for a stablecoin, but they also have a huge use cases, right? Which is 2/3 of the global GDP, which is supply chains, and this is the application for a stablecoin that they see. If you somehow can leverage a good chunk of the supply chains that are providing goods to the planet with something like a stablecoin, then there is no discussion about applications anymore. I mean, it's basically the economy itself that is going to work on the blockchain. Any more questions or comments on that?
Yeah. Hello.
Hello. Yeah.
Oh, I'm sorry I wasn't following too close and I didn't get much. And I hope this is not too far off of the question, but that DAI is a holy grail, or people say it's a holy grail blockchain, right?
It is said to be the case, yes.
Right. So it seems like it offers a lot of stability, right? It's stablecoin, and together with security, it looks like it's a good bet, let's say, for being, a coin, an actual, what Bitcoin was supposed to be, right? A coin that you can use instead of money. But I still wonder if it does anything to offer some kind of backup security other than what's being done currently, where you can lose, the Bitcoin if you lose your password or whatever.
If you lose if you lose access to your DAI, you mean?
Yeah. Is there any?
Well, DAI is a ERC20 token at the moment, so I would say that no, it's exactly the same situation as with any crypto currency. You'll have to handle your security yourself.
Okay, thank you.
What could happen, though, is, say, platforms like for, I don't know, crowdfunding, for instance, they could handle the back end for you. and you could say pay in euros for the product that you want to support, or the ID you want to support, but the platform itself would work with DAI. And so as a user, you wouldn't have to get involved into all this, but essentially you would be using DAI, on the back end.
Yes, sounds like a very open problem. You're looking for a solution then.
And this is actually what Stable, which is the solution proposed by Consensus as another stablecoin design, is using. So they wanted to do a back-end type of stablecoin design.
What does that mean?
Yeah, as I said, like provide a service to websites or companies or whatever to use a stable coin, but without asking the user to do all the dirty work, if you will. So you would pay with euros, but the system would handle everything in stablecoin.
Okay. Thank you.
Yeah. Okay. Yeah, you're welcome. All right. Well, if there is no more comments or questions, thank you very much for your attention. It's been over half an hour now, but I think, I had a wonderful time commenting all this. And if there's more interest, we can keep discussing it offline. So this concludes the third UnConference session, online session for Cryptoeconomics Hub. And we'll see you hopefully next week for another topic. Thank you very much and have a nice evening or night, depending on where you are. Bye-bye.
Bye. Thank you, everyone.
Bye.